Hi everyone, and thanks for joining me for our 2025 interim results highlights. It's been a busy first half. We've helped more customers than ever, returns are up, and we've built strong foundations for future growth. Interest rates have been higher than expected over the last couple of years, but with rates now reduced to 4%, as we mentioned in March, that's driving stronger demand for credit. Lower borrowing costs are helping us move closer to our 4 billion net lending goal and easing pricing pressure in the savings market. I'm really confident in our team's ability to adapt and make the most of the opportunities ahead. In July, we made the decision to stop new lending in vehicle finance, a move that will simplify the group further and sets us up for better long-term performance. It's the first step following our strategic review, and we've also identified growth opportunities in our other specialist lending businesses. We'll share more on those details at our capital markets event in Q4. Let's take a moment to spotlight some of the key metrics in the first half of the year. We're making solid progress towards our £4 billion net lending goal. Lending balance has reached £3.8 billion, which is a 6.1% increase since the start of the year. And if we look at just our core businesses, so excluding vehicle finance, lending grew by an impressive 7.3%. On the deposit side, we saw strong growth too. Customer deposits rose 8.2% to £3.5 billion, which allowed us to fully repay our TFSME funding ahead of schedule. Our net interest margin edged up to 5.4%, and our risk-adjusted margin was steady at 4.1%. Operating costs were up just £600,000 or 1.2%, which helped us improve our adjusted cost-income ratio by 460 basis points, bringing the ratio down to 49.1%. We also saw a significant improvement in profitability. Adjusted profit before tax climbed 36.3% to £23.3 million, thanks to strong income growth and tight cost control. And finally, our adjusted return on average equity rose to 9.6%, with our core businesses delivering an even stronger 13.7%. Based on this robust performance and in line with our progressive dividend policy, the board has approved an interim dividend of 11.8p per share. We continue to deliver against our Optimising for Growth framework, focusing on simplifying operations. The decision to exit vehicle finance and the redesign of our operating model will streamline the group further and unlock cost efficiencies. We're on track to deliver £8 million in annualised savings by year-end from Project Fusion, our cost optimisation programme. We've continued to enhance the customer experience. Over 250,000 retail finance customers have registered to manage their account on our app-to-pay platform. 90% of retail finance loan applications are auto-decision in under 6 seconds. And in savings, 98% of customers use our online banking service and 76% of maturing term deposits were retained. We've also focused on leveraging our distribution networks. We've grown our retail finance new business market share to 17.3%, supporting over 1,000 retailer partners, and we increased stock funding dealer relationships to 437. In real estate finance, client retention drove a 7.9% increase in net lending, and commercial finance lending grew by 10.7%. Let me now give a quick overview of our business performance. Retail finance saw net lending grow 9.8%, driven by strong lending in furniture, jewellery and season tickets. Net interest margin improved to 7%, and profitability remained strong despite a normalisation of impairment charges. In vehicle finance, before our strategic pivot, new lending was up 22.7% across consumer lending and stock funding. However, it posted a £4.5 million loss, an improvement on last year's £12.5 million, and is now in managed runoff. We welcome the Supreme Court's ruling on historic motor commissions and await further FCA guidance. While broadly positive for the market, uncertainty does remain. We've retained our existing provision for potential redress and costs and concluded that any changes to the provision are unlikely to be material. In real estate finance, net lending rose 7.9%, mainly in residential investment. Margins softened slightly, but client retention stayed high and the LTV in the book remained stable. Our commercial finance business grew net lending by 10.7%, supported by strong new business and low attrition. In savings, deposits rose 8.2% to £3.5 billion, with 76% retention of maturing term deposits. Fixed term accounts now make up 76% of total deposits. We were capital accretive in the period, and our CET1 ratio increased to 12.6%, comfortably above our minimum regulatory requirement of 9.6%. Our tangible book value per share rose 3.9% to £19.37. We've seen a strong improvement in our share price this year, although we continue to trade at a discount to book value. Looking ahead, with our current medium-term targets now in sight, our strategic refresh will enhance returns beyond our current 14 to 16% return on average equity target in 2026 and beyond. The run-off of vehicle finance is expected to unlock £25 million of cost savings, with capital reallocated to our higher returning retail finance, commercial finance and real estate finance businesses. Hopefully that's given you an indication of the good progress we've made during the first half of 2025. This is my final set of results before retiring. As a team, we have transformed the group into a more focused specialist lender with a clear purpose and strong foundations for future success. I'd like to wish Ian Corfield, my successor as CEO, and the rest of the team every success as they start the next phase of the bank's journey, and thank all those I've worked with during my tenure for their support. With our refresh strategy, there are exciting growth plans being developed to enhance our ambitions for the level of return we generate. Ian will share more on our refresh strategy and ambitions at a capital markets event in Q4 of this year, and I do hope you'll be able to watch that. In the meantime, if you would like more detail on our performance, do visit the Investor Relations section of our corporate website. Thank you.